Hello and welcome. You're listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. My name's Goose.
My name's Gabby.
And today we had a scintillating and deeply contemplative conversation around what, Gabby?
Vacancy rates.
Yeah, so we spoke. Vacancy rates. Yeah, vacancy rates. Yeah. So we spoke about vacancy rates, the misunderstood metric.
Yes.
We also went extremely tangential into mythological towns with gold mines, biopsychology, how vacancy rates are an indicator for future growth, how to navigate changing vacancy rates as an investor, the unusual impact of coronavirus on vacancy rates. Yeah. And ultimately why vacancy rates are more relevant than ever, and why as an investor you need to understand not just the number but the meaning behind the number.
Totally.
Did I miss anything, Gabby? Because we went pretty
No, we try to be as practical as possible about how you as a property investor or as a landlord or as a tenant, how vacancy rates affect you right now and how affect your long-term strategy, and kind of the signs to look out for and how you can respond when you see the early indicators.
Yep, great stuff.
Yep.
Now, this was inspired by Gabby thumbing through a copy of Limitless, The Renegade's Guide to Building Wealth Through Property. And I encourage you, if you haven't got a copy of that book yet, what are you doing? What is going on?
They don't like us.
What is going on? No, look, we had some, if you're listening to this and you're thinking, I did order a book and I haven't got it yet. It's because we did have a few shipping issues. We had a few shipping issues, but they are resolved. We found an Australian printer, Australian publisher, and we are back on. So if you want to get a copy of your book, order it now. Head to renegadespropertybook.com to check that out. And of course, if you wanted to expand your potential and expand your prosperity as an investor and as a real estate entrepreneur, head to theinvestorlab.com.au to discover the many, many, many ways that we are able to help you and to support you on your journey. We look forward to helping you. See you on the inside. Hello, Gabby.
Hello, Glenn.
How are you today? What the heck? Hang on. Whoa. Take a little step back there. I just got glenned.
You got glenned.
What the hell's going on?
I know. It's the Sunday. Brings out the Glen, apparently.
Crikey. Crikey. I feel like I've just gotten in trouble. If you are listening to this, we're recording this on a lovely Sunday morning in the beautiful Bondi Beach. The sun is shining. The air is cool. And I just want to take a little minute to kind of circle back, because a few episodes ago we talked about the seed of life and we did a sort of scoring thing. And if you listen to that, I hope you got a lot out of it, and I hope you engaged with that and did the work too, because it's super impactful. What we unpacked in that episode was that, long story short, the health component of my seed of life was lacking, and over the last couple of weeks I've been really thriving on the opportunity to incorporate more health and fitness routines back into my schedule, and I'm feeling really good, actually. So I'm feeling pretty happy on this Sunday morning. How are you feeling,
awesome.
Gabby?
Yeah, I'm okay. It's it is funny when you do those kind of exercises and you really own where you're letting yourself down a little bit. So I'm the same. Health. I think health is affecting everyone at the moment. I think everyone, considering the state of the world, everyone's a bit easier on themselves, because there's a lot happening, and it's hard to commit to health habits and get yourself out of the house every day and go for a run, or do your yoga or everything, because no one's watching you, really. If you're just at home and it's just you, it's quite a confronting thing to just commit to the discipline for the sake of it.
100%. So one of the things, though, that can contribute to health both mentally as well as physically, and also contribute to the intellectual capacity of people, is reading. And
yes,
what we want to touch on today. Well, you tell Gabby. Why don't you take the reins on this? You were flicking through. Tell me how we got to this.
So I was flicking through your book, as I like to do on my weekends in my spare time. I like to read more about Goose. So I I kind of stopped on this point about vacancy rates.
Mm.
And I know it's quite a hot topic at the moment with, just the COVID situation and the impact that it's having on real estate. And I feel like you kind of touched on it quickly in the book, but I feel like it's quite a misunderstood metric. And I just thought it might be a good basis of this conversation today to try and really pull it apart and go a bit deeper into it. And come at it from all different angles, because I think people see it as like one number and, you can apply it in the way that you think it needs to be applied, and then it doesn't really have an impact. But it's a much bigger piece, I think, that...
Look, I couldn't agree more. Actually, I think that I think the vacancy rates really are a misunderstood metric, and it's interesting because if you haven't got a copy of my book Limitless: The Renegade's Guide to Building Wealth Through Property, small plug there, grab a copy now. It's not an exhaustive exploration into all of the mechanics of real estate, but about 30-40% of it is about mindset and all of that kind of stuff. Anyway, I encourage you to get a copy of it and check it out, because I'd love to hear what your biggest takeaways are. I'm fascinated by the fact that Gabby was flicking through this and not the fact she was flicking through it, but more the fact that she hit the vacancy rates part and thought, this is something we could dig into a little more. If you haven't got a copy of the book, just head to renegadespropertybook.com, grab a copy there. But let's take this a little further. Let's dig into exactly why vacancy rates are relevant, and in fact, probably why they're more relevant than ever in the current environment. Gabby, you were telling me a really interesting stat about Sydney CBD vacancy rates there just a moment ago before we started this podcast. What are the Sydney CBD vacancy rates at the moment?
Well, yeah, I think as of this week, they're up at 13.8%. That's in the CBD, obviously. Sydney as a whole, as a city, is many more suburbs than Sydney CBD. But the CBD in itself is currently at 13.8% vacant.
Yeah, 100%. And well, not 100%, 13.8%.
Yeah, 13.8%.
Yeah, 13.8%. But the thing is, Greater Sydney more broadly is over 3% vacancy rate at the time of recording. And it's probably going to get worse. Like, let's be realistic, it's probably going to get a little worse.
Why do you think that?
Why do I think that? So there's a few key factors around vacancy rates. So let's quickly go into what they are so that people can understand the conversation. Yes. And then we'll talk about why they move, how they move, and why they're super important. How does that sound? That's a bit of a framework. Yep. Okay. So vacancy rates are and the indication point, or they're the metric that tells you the amount of vacant properties in a given area. Okay. So for example, and this is on a rental basis, okay, not on a selling basis or an ownership basis.
Yep.
So for example, if you have 100 houses in an area and 5 of them are empty and ready to be rented out, but they're not currently rented, so they're on the market to be rented, that would be 5% vacancy rate. Does that make sense?
Yep.
Okay, so if you've got, and you can expand and contract that metric as much as you want, but that's the ratio to consider. So you might go, well, 100 houses, only 5 being vacant. That's not too bad, is it? But here's the thing. So 3% is considered equilibrium between supply and demand. So in any given area, in anywhere in the country, the standardized metric that we all look for is 3%. If it's above 3%, that's not a good indicator. That is an indicator of a supply issue. So there's more supply than there is demand. Now, obviously, the variance on that will dictate the degree of that disparity. So, for example, there's been some suburbs that, like for example, Bundaberg is a really great example. If you go back 5 years, I think, in Bundaberg, the vacancy rate was about 6%. And it had been between 6 and 7% for a fairly long time. Maybe it was 3 years or 5. But anyway, in the last 2 years, it's been down below 2% and has been stayed below, right? So what you can see is previously it was extremely, like there was way less people wanted to live there and rent there than there were houses in a comparative analysis sense. And then now it's actually quite a tight market. It's actually tightening. Like Bundaberg is actually showing some really interesting signs of potential prosperity. We'll sort of get into how vacancy rates imply on that in a moment. But does that I don't know, just kind of on a tangent, do you think it helps people understand vacancy rates a little more?
Yeah, I think I was just thinking about what do you mean by the tightening, and how is that benefiting Bundaberg at the moment, or negatively impacting Bundaberg at the moment?
Yeah, okay, that's a great question, because it doesn't need to be Bundaberg.
Not Bundaberg specifically.
This can be applied anywhere, right? This can absolutely be applied anywhere. So if 3% is considered equilibrium, see, the 3% metric often gets a bad rap because some people, and I guess I don't want to sound rude, but I guess the more uneducated investors hear that 3% is bad. They 3% is bad. If it's 3%, it's no good. Well, actually, that's not true. 3% is equilibrium. Anything below 3% is what we consider degrees of tightening. Okay. Now, tightening, I'll explain the stages and I'll explain why they're important and how you can use this in your own investing journey, right? So if you think 3% is equilibrium, so it's a pretty good market. Roughly, there's enough rental properties for the amount of people who want to rent them in it's a very broad sense, right? But that's the general premise. So yeah, okay, shouldn't be a problem. It's not like you're not going to be able to find tenants. It's all good. But it does mean that the tenants will probably have a little bit more choice. They're not going to be desperate. They're going to be like, okay, cool, maybe I can look at a different house. There's going to be a little bit more opportunity. So what that decreases is your ability to be extreme in your vetting process, if that makes sense.
Yeah.
All right. So there's going to be a bit more of a balance in the negotiation. It's like two sides of the party coming to the table in a negotiation. If there is even distribution of power, then either side could take it or leave it. And they'll just be like, well, is this what I want?
It's a healthy economy.
Well, yeah, it is, right? It is in that sense. From a tenant versus a landlord perspective, it's everyone's kind of even on the table. It's like, do I want this or do I not want this? What have you got to offer, and is it suited for me?
Yep.
That's like 3%. So think about it like that. Now, taking that down a degree to 2%. 2% is considered extremely tight. So what that means is that there are obviously less properties on the market available to tenants, or vice versa. There's the same amount of properties, but there's more people that want them, right? So it's about the balance of the equation. So to that degree, you're as a landlord or as a property investor, as a property owner, you're going to have more opportunity to be a little more discerning about who you want and are they good enough tenants and all of that kind of stuff. And again, taking a step back, 3% is good. 3% is good. Like 3%, anything less than 3% is good.
Yep.
Okay, so let's not get caught up in is it 2, is it 3? Or these are all good things. Now, 2% is considered to be extremely tight. I mean that it's extremely tight. 1% is considered to be crisis levels. So 1% is where there is a rental crisis, where the demand is extremely outstripping the supply of rental property availability, and it's actually a problem. There's actually social cohesion issues to a certain degree. So when we see media reports about the rental crisis and all of this kind of stuff, it's real. This is the scenarios that you find yourself in, where you have a tenancy, an open home for a rental inspection, and you have 30 or 40 people, and they're all like fighting it out, and they're like, I've got my application ready, and I'm ready to go, and I'm the best candidate, and I've got 92 references, and I'm a doctor in five areas, and like, look at me, pick me. Right? This is like when you get to 1%. And obviously, I'm exaggerating that a little bit, but 1% is considered to be crisis levels. Anything below 1% is, or even more crisis levels, right? So you get that.
Yeah. So I'm drawing the correlation between, if you're a property investor and you understand buyers and sellers markets.
Yep.
So when there's a increase in the vacancy rate, it becomes basically a renter's market, right? Because the renters have more choice. As we're seeing it now, there's the opposite of what you just explained. There's not so much competition of people fighting for the limited amount of rentals that are available and trying to compete with each other and prove their worth, which in that case, it's more of a property owner's market. It's the landlord's market, which would be the same as a seller's market.
Yep.
Whereas that's when vacancy rates are low, whereas currently now vacancy rates are through the roof. So the tenants are more in power. It's more of a renter's market. They've got more choice. They've got more flexibility. There's way more supply on the market that they have to choose from. And then obviously that brings down rental prices as well, right?
It does. It does. I think a couple of things you just said there. So vacancy rates are not through the roof. They are in some areas. Actually, let me just take a little step back. They actually are in some areas, and it's not good. Now, the reason some areas are significantly impacted by vacancy rates at the moment is an unusual causation, and that's because due to the coronavirus, which is, impacting everyone in a variety of different ways, we've got decreased tourism, which means that Airbnbs are no longer viable.
Yes.
The whole Airbnb market has crashed, right? And the whole back end has fallen out of it, and it's very challenging. So what a lot of Airbnb owners are doing are putting their properties very quickly. They're slamming them back onto the long-term rental market. And what that is causing an increase in supply in rental markets, and that is tipping the scale of the supply-demand equation in those areas. So typically that's going to be areas more impacted by tourism.
Yeah.
Okay. So you are seeing some areas where the vacancy rate has gone up significantly. Like I'm talking multiple percentage points over the course of a couple of months. It's pretty gnarly. That actually also has an impact on values, property values as well, which is really interesting. So some areas that have been impacted to that degree from a valuation perspective, and again, values are only really discovered when you transact. Okay, so what this is looking at is valuation impact as opposed to like what the median market change in selling prices has been. But for example, somewhere like Tugun in the Gold Coast is significantly impacted. There's been a lot of, and I'm just using that as one microcosm example, there has been a significant amount of Airbnb properties come back onto the market in that area. That's increased the rental supply. That has decreased the property value comparison because it's easier for people to rent. There's less demand for people to buy. People have got more options. And for investors, it's driving down the capitalization of their asset. Does that make sense?
Yeah, I was just thinking through how the vacancy rates changes at the moment are actually, like when you say it's affecting the valuation, what do you mean by that?
That's a good question. So in any environment, any market, I don't care whether you're dealing in diamonds, gold, grass clippings, properties, stock shares, it doesn't really matter. But there's always a supply and a demand aspect to any value point.
Yep.
Any value point. I mean, I could have the nicest coffee cup in the world, right? I could have crafted the most beautiful and amazing coffee cup, I think. But if no one wants it, it's literally not worth anything.
Yep.
Right?
Yep.
So we're going to get into supply and demand economics here, I think. So
it's good.
There's kind of a few different ways to look at it. If you have less supply and more demand, then the value increases. If you have more supply and less demand, then the value decreases. It's a very simple premise.
Yep.
But what people make the mistake of as well in this is thinking that it's purely based on numbers. Like if there are 100 properties in the area, if there are X amount of properties and X amount of people, therefore property prices go up or property prices go down or whatever. But that's not the case at all. Like that is one piece of the supply and demand equation, but the demand equation is actually driven by a whole suite of other factors. And this is I'll loop this back into vacancy rates in a moment, but let's just go there because the demand factor is not indicated by the number of people. Now, a lot of people talk about there's no international migration, right? So there's no net migration, international migration. Mm-hmm. And so therefore the property market is going to crash. Well, that's not necessarily a true factor, okay? Because when you think about property prices as opposed to property vacancy rates, they're two different things. Property prices are driven by the buying and selling of properties, and vacancy rates are driven by the revenue generation capacity of an investment property, okay? So vacancy rates are specifically related to tenancies, right? Property prices are specifically related to transactions, but these two things are intertwined. Now, if you think about, let's just talk about demand for a moment, because demand can change without net population differentiation, which is a very interesting concept because everyone thinks that more population, more people for the same amount of houses instantly means more higher values, which is kind of true. But also, the inverse then would be true, and like less people would be less property price growth, and the same amount of people would be static property price growth. Right? That would be your three metrics if it was just based on the number of people. But if you were to just take a hypothetical scenario, right, and you were to take, let's just make up, we're going to a fictional territory here, right? But let's just say there was a town in regional New South Wales, and for the last, and there was like 1,000 people or 10,000 people, whatever, lived in the town, right? And none of them ever went anywhere. It was a small country town, and everyone grew up there and died there, and nobody ever moved there because there was no reason for people to move there. And for the last 20 years, they'd been struggling. They'd been on the bones of their ass. There'd been no major industry. Now everything was dusty. There was tumbleweeds in the streets, and everyone was withered and worn, and life was slow, and nothing really happened. But everyone just hung on, and they were just hanging in there. And it was literally it was like they were at the death rattle of their community. If I painted a good picture.
I don't know if good's right, but yeah.
Okay, but then something changes. Right? All of a sudden, some random guy comes to town and he discovers that there's gold, right? For example, right? And he goes, "Oh my God, there's so much gold right here, right in this town. How wonderful!" And then he stimulates with some new industry, some new input, some new infrastructure, some new energy. And all of a sudden, and he doesn't need to bring in, let's just say, hypothetical situation, he doesn't need to bring in any other people from any other areas. He discovers that everyone in the town has all the skills that are required and all of this kind of stuff. But everyone in the town starts making more money. They start living out, they're happier. There's a way more optimism, and everyone thinks, "Oh my God, we're going somewhere. How good is this? Life's changing. We're changing. The world's changing. My perspective's changing. Everything's changing." What do you think that they do? Do you think that if you lived in the same crusty, old, weathered, run-down, dusty, dilapidated town, house, whatever, and you all of a sudden had more economic prosperity, more optimism, more future potential, more happiness, that you'd think, you know what? Maybe it is time for that little renovation. Maybe it is. You know what? I do want to buy that bigger house. I wonder if David down the street wants to sell that. And this drives demand. Okay, what I'm getting to is psychology. Okay, biopsychology will dictate a much bigger sway in property prices and vacancy rates than anything else. Okay, now at the moment, what we're experiencing in the current market is higher rates of unemployment, but really it's higher rates of uncertainty. So uncertainty makes people really start to retreat within themselves. If they don't know what the future holds, they refuse to spend the money. Now, when we look at Sydney's vacancy rates, for example, and we see that they have gone up significantly, they've been going up for a while, actually. Like, I have actively been looking in the Sydney market to buy for our clients for some time, and I've yet to really find somewhere that I think is robustly a good opportunity. And when you look at the market at the moment, the vacancy rates are trending upwards in so many places. Now, that is driven by a large number of things: affordability, sentiment, certainty, and all of these different factors. Yes, unemployment does play a role in that, of course, because if people don't have jobs, they can't afford the rent. So therefore, they go, "I can't afford the rent. I've got to move out." You get rental defaults, and that puts more properties on the market. Okay, so then, we're talking about a much broader thing here, and we're talking about the psychology of how this is impacting. Now, I've kind of lost the point of the question. I've gone very tangential here, but I think that as much as anything, the reason that vacancy rates are an indicator of property prices as well is because of that kind of intention. So, for example, in some of the areas that we're currently buying in, vacancy rates are 0.5%, 1%. So if you're in a market where you've got 0.5% vacancy rate and then your vacancy rate doubles, what do you got? Still got crisis levels, right? Yeah. There's still a huge amount of demand. But when we see, I think the question was about tightening and loosening vacancy rates.
No, it was about how it's currently affecting valuations.
Okay, yeah, got it. Okay, so we'll come back on the tightening thing and how that affects, how that's a predictor of growth in a moment. That's a good question. I'm just distilling my answer there, right? So, from an investment perspective, if there is less potential for the property to generate the returns and the revenue required, it devalues. So just in the same way, you think about a business. Okay, now of course, not every property is a rental property, and not every property is going to be bought by an investor. Okay, so there's kind of a couple of things.
Yep.
On the one hand, you've got more available properties on the market, and you've probably got more people willing to sell. Right? If you've suddenly got all these Airbnb properties that suddenly can't make any revenue, they're going to be like, can I rent them? Can I sell them? Right? So you're probably going to see a glut of both. I haven't actually looked at the gross number of increased listings in Tugun, so I can't comment on that specifically, but it would be a natural correlation that you would expect. Okay.
Yeah.
And also, it means that the prospects for an investor to want to invest in an area, so investor demand, will go down. So there's less demand for purchases in that area because the investors are not going to be able to get the returns that they need to make it a worthwhile investment. So therefore, that's pulling back on the demand side from buyers. These it's kind of like a little ecosystem of things that work together. But if you see vacancy rates going up, you can be fairly sure that you're going to have a much softer valuation perspective in the marketplace. Now, that doesn't always mean things go down, but it might just mean things go flat. So the two things are very different, but also extremely correlated.
Yeah, so it's kind of like, in a general sense, lenders don't tend to like the short stay market, the Airbnb market, from that perspective, right? They don't, because Airbnb is probably a bit more turbulent in terms of guaranteeing rental income. So they are a bit more conservative in valuing those properties, right?
Yep. Yeah. So from a lending perspective, and again, it's not financial advice and I'm not a broker, right? So from a lending perspective, there's a couple of things. Airbnbs are not considered a rental property. They're considered a business. So as such, yes, an Airbnb in, let's say a year ago could have been a good cash cow opportunity for you to produce a lot of income, but it'll be treated like a business. Mm-hmm. You need to have 2 years of consistent revenue, consistent tax, all of that stuff. Same thing you do with the business. Right? You can't just go, look, hey, I've got a property and it yields at 10%. Boom, let's go. They'll say, yeah, but it's a short stay. What's the vacancy? How many weeks? What's the total annual revenue? They'll want to look at it like a business before they'll lend against it. That's the difference, right?
Yeah, cool.
Now, to that degree, to touch on another point, vacancy rates and lending and risk analysis. So not all areas are created equal. So if banks have got different classes of risk, so the class 1, 2, 3, ABC, there's kind of different metrics or different scales that they use, but essentially they class areas in different ways based on the risk profile of that area. Now, the risk profile of an area, according to a lender, is not always not always up to speed with the current conditions of an area. Maybe a little bit outdated. We've discovered that a few times in the past. We've found areas which are great, low vacancy rates, high economic prosperity, gentrifying demography, all of that kind of stuff. But the banks have still said, "Oh, that's actually a class 4 or whatever it was, right?" Yeah. We don't want to lend at 90%. Okay, so that's cool. But you do get these kind of things, which is why if you're buying in a regional area. So when we talk about regionals, when we talk about investing, and we're talking about major regional cities, right? We're talking about areas like Bendigo, Ballarat, Albury-Wodonga, major regional cities, which is massively different to a small country town, right? Massively different from a lending perspective as well. So from a risk perspective, banks always hedge against risk. Just in the same way that vacancy rates are going to, they're going to be like, well, if vacancy rates are going up, property prices might go down. We're going to value it differently. We're not going to secure a higher amount against it because there's too much risk. So, just in the same way, if you are investing in a country or a regional area, like for example, if you're buying a farm or you're buying in a small country town or something like that, the loan to value ratio needs to be much lower. So you need much higher deposit. to de-risk the bank's position, and that's based on the risk profile of the area.
Awesome.
Cool.
Yeah, maybe let's bring it back a bit to how can we use, as an investor, how can we use a vacancy rate almost as a tool? Like you touched on earlier about how it can be, an early indicator of capital growth, which I think a lot of people don't really think about vacancy rate in that way. They think of vacancy rate as an element of assessing their cash flow, and they think, okay, well, if there's a 1% vacancy rate, then there's like a 1% of my rental income that I won't receive that year for that property, or they'll factor it in that way. But you touched on before about psychology and about psychographics. And I mean, what comes to mind there is the concept of tenant appeal, and how if a vacancy rate is dropping, you'll have more tenants moving in there, right? And if you think about tenants as people compared with owner occupiers as people, tenants tend to be more fluid, right? Tenants move around a bit more, they're a bit more agile, and they're a bit easier to relocate if they find somewhere that they want to move to. But do you see that as an indicator of almost a pre-indicator of capital growth in certain areas?
Yep, I do. And so it's a really good point, because it all comes down to the psychology, and this is what people miss. People just look at the number and they go, "Oh, is it low? Is it a low vacancy rate? That's good, right? Low vacancy rates are good, yeah." Yeah, that's cool. But why? Why? Like, why does that even matter? I know we've spoken about the supply-demand ratio and all of that kind of stuff, but psychology is actually a much, 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 much bigger part. Now, you can look at an area and let's just say the vacancy rate is 2%, and you can go, "Oh my God, that's great. Goose said that 2% is tight. How cool," right? But what you really got to break down, and this is why it's so important to understand the psychology of marketplaces, because capital growth is such an esoteric future perspective.
Yeah.
Now, there are ways that you can reasonably project, but it's pretty complex and anything can change, right? So there's something like the coronavirus comes along and all your best assumptions are gone, and all of that kind of stuff. However, looking at how the data that we can find right now can give us a glimpse into the future is super fascinating. So, for example, if you looked at an area and it was 2% vacancy rate, and you went, "Oh, well, it's 2% vacancy rate. Like, I don't know, I'll just go buy an apartment," right? The vacancy rate for 2-bedroom apartments in the area might be, I don't know, 6%. But the vacancy rates for 3-bedroom houses might be 0.2%. Okay, so what you can discern by looking at the vacancy rates per asset type and doing comparable analysis on that is to determine what the psychological and demographical breakdown is of the community. It's not the only thing you would use, of course, because that's not going to dictate who they are, how they spend their time, where they work, and what they do. But it will tell you a lot about the community. So, for example, the people who are more likely to want houses with backyards are probably going to be families and stuff like that. So then you can sort of discern that. You can sort of follow that rabbit warren and start to understand about the types of people that are in the area, and the types of people that are moving to the area and why. Now, that's a really great thing about the psychology. The other thing, as you pointed out, is that tenants or renters are a leading indicator. They're a leading indicator of future prosperity and potential. The reason for that is if, for example, like in our mythical made-up New South Wales country town where nothing's going on, if people decided that they were going to move there to work in that gold mine, then they wouldn't just go and buy a house straight away. They would move there, they'd find somewhere to rent, get a feel for it. Well, is this a good street? How long am I going to stay in this job? Is this what I like? How do I want to bring up my family here? What are the schools like? And then only if it met all of their lifestyle criteria and they decided that this is somewhere that they wanted to spend a greater proportion of their life would they buy. So rentals. So this is why when we're looking at markets and when we see vacancy rates decreasing and rental prices and yields increasing in line with each other, that is a really good sign, because what that is showing is that there is an increasing level of demand, typically driven by more people wanting to be closer in that area for a variety of different emotional, psychological, economical, and demographical reasons. Okay, could be affordability, could be new jobs, could be nice beaches, could be any number of different profile characteristics that are going to drive them to want to be there. And once they then move there, and we see that's one of the leading indicators. Once we see that, then if they enjoy the place, that's kind of leading indicator. Then in about 6 months' time, typically in about 6 months' time, you start to see a change in housing prices. That's just a really interesting thing is that the average timeline, and when you look at these at an aggregated average perspective, the average timeline for that process is about 6 months. It could be longer, could be 12 months. But if you think about it, if we were to, or if the listener was to go, let's just say I live in Sydney now, and I just got offered a job in Brisbane, and it's a great job. All right, let's move the family up there. All right, what are you going to do? Are you going to take on a 12-month lease? Maybe. You might also take on a 6-month lease. Okay, because you're like, look, let's give it a crack. If it's no good, maybe we'll come back. I don't know, or whatever. You work it out. So it's going to be between 6 and 12 months. But if you go and take a 6-month lease and you go, okay, this is good. This will give us an opportunity to get our feet on the ground and find a place to buy. And this is the kind of perspective of why vacancy rates can be a leading indicator of future growth potential. The thing that you've got to be very, 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 very careful about, though, is supply risk, because what can look ostensibly like a great and tightening growth potential market can be completely decimated if in amongst all of that there is a 200 apartment block about to open its doors, right? And all of a sudden that can flood the supply side of the market, and that'll bring that whole equation back to equilibrium. And so this is the kind of thing. This is where the supply side comes into the demand side.
Cool. Yeah. Okay. So let's touch on that a little bit about. So say vacancy rates trending down, right?
Yep.
It's tightening. What are some indicators you would look for that would indicate that it's going to loosen up a bit? The supply is about to increase, or it's about to come back to equilibrium. Like you mentioned just then, like residential development. Like you see a lot of new developers coming in, whether they're like apartment buildings or they're new like land developments or.
Yep. Honestly, the easiest way to do that, and the only real way that I know how to do that, is to look at the building approval rates. And you'll find that kind of information by digging into council planning departments and stuff. It's pretty dry administrative work, but it kind of does really give you a really good picture of what's going on. So, for example, you may find a house that's super cheap and really high yield, and the suburb vacancy rate, and this is really, we're getting into microburbia territory here. The suburb vacancy rate might be, let's just say 2%, right? So the suburb vacancy rate is 2%. Oh, that's good. And I found this house, and it's like 30% cheaper than every other house in the suburb, but it's on the back. Let's just say it's on the back side of the suburb. Let's just say the front side of the suburb is right up against a train line, and it's close, and there's the shops, and there's a supermarket, and maybe a cinema, and all of that kind of stuff, and it's connected to the capital city, right, in some way, in some meaningful way, and maybe it's an outer ring suburb. And on the back side of that same suburb is paddocks, fields. Now, what you've got to sincerely and significantly look at is, what is the future plan for that land? How long will that stay farmland? Is that even still farmland? Has a developer bought it? How many lots are going to be coming online? In what time frame? And this is one of the reasons that I see a lot of areas where people rush to, and I'm like, there's no way that we'd be going there with our clients, because when you look at where an area is, and I'll use, for example, Strathpine, right? So Strathpine, Moreton Bay region. Don't get me wrong, if you bought there 4 years ago, you probably did pretty well, and you probably will do pretty well. But the problem is, when you look at the Moreton Bay region, and then you look at the point of greatest utility being Brisbane, and then you look at the area in between, there is a huge tract of greenfield land. Now, the majority of that land has already been bought up by companies such as Stockland and other developers, and they're going to be releasing thousands of new houses onto the market. Now, what that will do is that will increase the supply side of the equation, okay? And assuming that the demand side stays the same, lifestyle, economic opportunity, psychology, prosperity, affordability, all of that kind of stuff, it will stunt growth, okay? Now, conversely, if you were to invest in an area where you are, let's say the main access point and the main opportunity for convenience, because lifestyle is one of the biggest factors. Lifestyle and psychology are one of the biggest factors in the value proposition of any property. And that can be seen in many, many, many ways. But just because it's close to a train station, that doesn't mean it's a good thing. If everyone has to drive for work, if the main economic opportunity for that area is not accessible by train, then being close to a train line doesn't mean anything.
Yep.
Right? And we often see train lines, but then there's only going to be 2 trains a day. Like the train line isn't the be all and end all. It really depends on what the occupational breakdown is of that area. Anyway, let's say you're looking at a house and it's surrounded by other houses and surrounded by other houses, and there's not really, you can't see any big spaces of land that more people are going to be building more and more houses on. That's a good sign that there's only going to be infill developments. Infill development is like maybe subdivisions, maybe a corner lot, like little stuff, which is not going to dramatically impact it. Now, if you want to look for apartment buildings and stuff like that, you really need to look at the building approval rates. So you need to dig into that kind of developmental side and go, okay, what projects are on the horizon? Are there 2,000 apartments being built in Footscray over the next 5 years? How is that going to change the demand? And you need to start thinking about that kind of stuff. Does that make sense?
Who's responsible for managing the vacancy rate?
What do you mean managing the vacancy rate?
Like improving it if it gets to crisis levels, or decreasing it if it's
state government. Yeah, so state and local government will dictate the planning and development of the infrastructure and all of that kind of stuff in the state. So they're the ones that, like, don't get me wrong, federal impact, of course, federal funding to state level, state funding to local level. This is the flow of the federal treasury in a general sense. There's obviously state generated revenue and there's all of that kind of stuff, but we won't get bogged down in all of that. But states will dictate how they want their state to be. They're the planners. They're the planners, right? And so they will be, okay, how much are we spending on roads? How much are we spending on hospitals? Where do we have too many people? Where do we have not enough people? How do we move people from an area where we have too many people to where there's not enough people? And how do we make sure that's going to be done in a way that's going to be economically prosperous for that environment, that we're not going to be transferring issues and transferring problems? You know, a really great case in point with this is Victoria. So Melbourne's had the highest level of population growth for the last few years. Isn't it funny how it's also had some of the most volatile and unreliable growth rates in the last few years as well, isn't it? Isn't that hilarious? Isn't that funny how it's had the highest population growth, and in a lot of cases property prices have been going down? Isn't that unique? Well, that's a really great indication about how population growth doesn't mean shit when it comes to property prices. Now, aside from that, too many people started moving to Melbourne. We lived in Melbourne. We're in Bondi now. How cool. How wonderful. For now, maybe Byron soon, we'll see. But I got lost. So the amount of people moving to Melbourne was putting too much pressure on the infrastructure. Melbourne literally cannot build infrastructure fast enough. And this is the bane of every growing city. You just can't. It's virtually impossible. Yeah. So what the state government has done has been pushing more economic opportunity into satellite hubs. So places like Geelong, even within the city, they're doing that in places like Sunbury and places like Dandenong and these kind of satellite positions to try and move people out, because they can't have people just constantly trying to pressure towards the center of the city, because it'll break. You know, you'll have social cohesion issues. You'll have huge problems. This is the thing. Like, this is the big picture thing. Now, further to that, they've decentralized, and we've seen the growth stories in places like Ballarat and Bendigo. And we're now starting to see that ripple even further out, and it's going out in concentric circles. I find that Victoria is a very good case in point for this whole metaphor, because what we're actually seeing now is that places like the Latrobe Valley have seen really good prosperity. Places like Bairnsdale and Paynesville, way east, have been on the receiving end of decentralized prosperity, funding opportunities and stuff like that, because sometimes it doesn't come by the state government doing a big project. It might just push more funding into the local government and go, look, you've got this money now, do something good with it. Expand your hospital, do the thing. And so there's many strategies around how to do that. We're seeing that in places like Albury-Wodonga and heaps of other good stuff. So that's where the control factor comes from, and that comes down to the overarching planning and economic development plan, which is really interesting, because if you want to look at an area like, I don't know, Ipswich, right, for example, you can go on the council website and you can look up the economic development plan.
Yeah. Yep.
Now we all know
they're a fun read.
Plans without action, plans without action are just toilet paper, right? Nonetheless, you can get an indication of what the plan is. And then you can actually, if you really want to get nerdy about it, you can then look back at their previous plans and then analyze what their efficacy rate was of completing those. And you'll find that some councils are way more effective at delivering on their plans, right? And their projections are maybe more accurate. So Ipswich is actually a really good example. And Sunshine Coast is a really good example as well. Both those councils have got very good track records of doing what they say they're going to do and meeting their targets. So, for example, population targets, because these are real things. Governments, local government areas will go, well, if we want our area to be more prosperous and to have more opportunity and to be more buoyant and to increase our gross regional product, we're going to need to do a certain amount of things, including more population, more jobs, more all this kind of stuff. And so they'll have population growth targets. So you can kind of get an indication of, if a tiny town in country New South Wales has a population of 1,000 people and it says in 10 years we're going to have a population of 1 million, and the way we're going to do that is by building the world's largest Woolworths, you can sort of go, okay, not sure.
Yeah, it's almost like they have their own integrity score within them, don't they?
Yeah, like anyone. It's like you got to think about everything's a business, right? I'm sorry if you're a socialist out there and you want everything to be a community, but it's actually everything's a business. And my point to that is that real estate is a business, government is a business, and you need to view each and every business opportunity on its merits. You need to, just because a property is advertised in a certain way doesn't mean that it is what it says on the box. And just because a local government area says we're going to do all of these wonderful things, it's like, yeah, but I don't know, are you a liar? What's going on? And you've got to look at all these business opportunities and these different stages and tranches of business psychology and the profile of what you're doing.
Yeah, and I think the interesting part of that as well is how, the integrity of any level of government actually has a massive influence on the economy of that government, because if you feel confident and you feel like you've got a trustworthy leader, you feel more confident in spending your money in that economy, right?
Oh, 100%.
Which in effect in real estate should lend to increase prices.
Yeah, exactly. So
generally speaking.
Yeah.
So if you're in a local government area and they've had the same government in there for years, and it's very stable, you're going to find on the ground that there's a lot more certainty in the people, because the government has have set the outline of what they're going to do, and then they go and do that. Yeah,
political uncertainty is one of the banes of property.
The
more elections, the worse things are for property. Not because it goes bad, but just because of uncertainty.
Yeah.
So what people miss about in the whole property economic equation is that the biggest, most important thing is psychographics. How do people feel? What do they want to do? Like psychographics are so interesting because you may have people who have the very same economic opportunities. They have the same job, that nothing's changed, but except for the fact that now, thanks to coronavirus, they can live wherever they want. They've got a decentralized workplace. And so rather than saying, oh, I need to live within an hour's commute of the Sydney CBD, they're now free. They're now free to live where they want. And all of a sudden, they might go, well, you know what? I want to move to Yamba. I only need to go to the office once a month for the team meeting. So I'm going to move to Yamba. Property prices are cheap. Beach looks good. Awesome. And this is lending into the psychographics of why people would move to an area. Nothing ostensibly may change about Yamba except for a desirability from a lifestyle perspective. And desire is the leading indicator of everything. Like desire is the leading indicator of how you're going to spend your money. Like, you could look at two cars that are exactly the same, and one has a Mercedes badge on it and one has a Honda badge on it, and they would be two drastically different prices because of desirability, not because of mechanics.
No, we're going to do a whole another episode just on psychographics, because you're right, it is such an important and overlooked aspect of everything that we're doing.
Yeah, 100%. Yeah. Which is, I think, I know we started on vacancy rates, but I'm passionate about this, right? So this is why when we look at an area, we don't look at it what it is now. We look at what it is becoming, right? So, for example, you may go to an area which has for the last 5 to 10 years been let's just say lower socioeconomic demographic, all of this kind of stuff, maybe higher unemployment or whatever. But if you can see how it's changing, if you can see the demographic shifts and the psychographic shifts, and if you can reasonably see, if you can find the statistical points that you can then use as a reference to understand what is happening in that degree, you will be able to see the future in terms of what it's going to do and what the potential of that area is.
Nice.
Cool. Indeed.
If you're a property investor,
yep,
and you own a property,
yep,
and let's say you bought in there and the trend was going down and vacancy rate is now at about 1.5%. If you start, tuning into the vacancy rates and paying attention to it a bit more, and you start noticing it increasing, what can you do? What effect does that have on you as an investor?
I'm going to turn this around a little bit. If you're a business owner and there was more uncertainty in the marketplace, what would you do? You would increase the value proposition. You would say, dear valued customer or client, I love you and respect you, and together we have a mutually beneficial relationship. Now, I understand that in the current environment, things are changing. And you may have an increased opportunity or an increased desire to maybe want to explore alternatives, competitors in the marketplace to find out if they may benefit you more in some way. Well, I want to let you know, dear customer or client, that I really value you. And what I am committed to is having a prosperous and long-term relationship with you. And I want to support you on the journey from where you are now to where you ultimately want to be. So how can I make this relationship satisfactory to you? Or are you currently satisfied? You got to have that. You got to have that perspective. And this is where service comes into it, right? Because if you're just like, God damn tenants, screw them, give me my money, it's probably not going to be that great a relationship, and that essence will be coming through in the relationship that you have with the tenants. If you never fix anything, if they're like, I am so sick, sick of this, the shower leaks, the power doesn't work, nothing, the place is broken, and I am sick to death of asking and nothing happening to this place, stuff it. Rents are going down. I'm just going to go rent somewhere else cheaper. That's the attitude. And that's the same attitude that somebody would have within a business. If they're like, I can't believe I pay this much money and I get such a crappy service. It used to be there was nobody else to go to, but now there are loads more other people I can go to. Screw you. I'm out. I'm going to take my chances somewhere else, right? Same perspective. It is exactly the same perspective. So to that degree, the level to which you can show compassion, servitude, community connection, and all of that kind of stuff, you will weather the storm with your client being your tenant. Now, there's a number of reasons that vacancy rates may go up. It may be in a current environment like right now. Like, for example, right now in Sydney, vacancy rates are going up in many, many, many places. So what opportunities does an investor or a property owner have to ensure that they don't find themselves without a revenue stream to support that asset? There are many things you could do. You could offer lower rents. You could say, look, I understand your current position may not be what you wanted or what you expected when you entered into this relationship, but I love you and I care about you and I want this to be a long-term relationship and I value you as a client. So how can I help? Would it be beneficial if I reduce the rent a little bit? It's got to work for both people. It has to work on both sides, right? That's just one way. Yeah, but there are many ways. It's about increasing the value proposition to secure an optimal result for both sides of the transaction equation.
Yeah, it's interesting. I'm kind of now thinking of it like thinking about service as a landlord, serving your clients, which are your tenants, almost as insurance for times of increasing vacancy rates. Because you think like when it becomes going back to the trending towards, a renter's market, when renters have more opportunity and there's more consideration and they have more options, they start to think about why what they currently have is not good enough, or why they start comparing it with what else they could have, and why all the other new options, the new shiny options, are in some way better than what they've currently got. And that's what I think, that coming back to that psychology, is a reason why people tend to move around in those markets. But if you're, as a landlord, if you're delivering good service and it's, priced appropriately and you treat them well and you practice empathy and do the maintenance that you need to do and serve them ongoing throughout the whole tenancy, you're going to have less risk of a tenant wanting to jump ship.
Well, people stop thinking about it as a temporary solution. They start thinking about it as a permanent solution.
Mm.
If the value proposition is correct, people don't want to move. Like, tenants don't like moving.
Yeah.
The cost of moving is extremely high. People don't want to move. Some people want to move around. I enjoy moving around because I like change, right? But in general sense, people don't like moving. They want a home.
Yeah.
So if the value proposition is correct, why would they want to try and create a new home?
Yeah.
Humans are creatures of habit. They may have a routine. I like going to that cafe. I've got a gym around the corner. I made a new friend. They don't want to have to change. People want that kind of environment. So the only reason that people would change is if the value proposition has changed for them. The value proposition may have nothing to do with the landlord or the property owner, right? The value proposition may have changed for the tenant. They may be like, well, when I entered into this, I was on $100,000 a year and I just got a new job and I'm earning $250,000 a year. And now I want to go to some pimpin' penthouse apartment, or I'm going to go buy my own house, or whatever that may be.
Yep.
Yeah, but and that's normal. That's all good. That's all good. But in a broader sense, you need to approach it from how am I providing the right service to attract the right people? And I think that this will show up in a multitude of ways. It'll show up in maintenance, care, consideration, all of that stuff. But the more that you can turn it into a home and not just a transaction, because you got to ask yourself, like, what do you want more out of your rental property? Do you want to be able to jack up the rents every 6 to 12 months just cause you can, because you can get more money? Yeah. Or would you rather have a tenant in there that when you purchase the property, you got tenants in there at the rental rate that was satisfactory to your needs, would liquidate your portfolio. So we're talking cash flow positive, all of that kind of stuff. They're happy, you're happy. Wouldn't you rather have the same tenants for 10 years?
Totally. Yeah, you see that that's listed as a benefit on so many listings. It's always long-term tenant is listed as one of the selling points of property, because you do want that consistency.
Yeah, 100%.
You want the reliability as much as you can.
Yeah, and if you think about it like a business again, if you run a business, what do you want more in a business? Do you want repeat customers who come back to you? regularly who already know you, like you, trust you, value your product, and want to do more business with you consistently and become habituated. I find a barber. I'm going to the barber this morning. I go to the one barber. I don't shop around barbers. I don't go to different barbers. I don't even go to different barbers. I don't even go to different barbers at that barber. I have a barber. His name's Theo. He's very nice. And I go to that barber in that barber shop. Why? Because he cut my hair good once. And I went, he cut my hair good.
Done. Decision made.
Yep. Cool.
Yep.
I'm going back there.
Yeah.
And I'll keep going back there. I won't book in with anybody. In fact, I tried booking in with someone else once, right? And I was like, I didn't like that.
You didn't like it.
I didn't like that. It's like, where's Theo? Come back, Theo. And so now I'm like, okay, I know what I'm going to do. And this is the kind of relationship that you can generate as a business owner if you approach it in the right way, because there is nothing more damaging to a business than trying to create new clients or customers consistently, because no one wants to stay with you. That is the lowest level of economic strength in any kind of business structure. Same thing goes for property, because property is a business, right? So the thing is, if you can create an environment where people want to stay, you're attentive to their needs, you listen to their hopes, dreams, desires, concerns, needs, fears, and wants, and serve them, then they'll stay.
Yeah, it's interesting. I think this is a good point to wrap it up with. About, you talk about like 10-year tenant, like that's the goal, right? You have a tenant, the same tenant,
100-year tenants, 100-year tenants
that stays there your entire life. And they're happy for you to increase the rent as is necessary. And then they're not fussed. They're totally stoked. They're like, I just love where I live. Just let me live here. I'll pay whatever. Just let me stay here. But I think coming back to vacancy rates, about a lot of people, particularly at the moment, people that are buying now, raising questions about, am I going to have difficulty finding a tenant right now? Should I invest right now because I might have difficulty finding a tenant? But if you think about that as the 10-year tenancy type of thing, we're reminded that we're doing this for the long term. Property investing is a long-term game. And vacancy rates in one respect is just a piece of that. And so if you're buying in good locations where, the places that we're buying are everywhere is less than 3% vacancy rate. So if you're buying somewhere that might be 1% vacancy rate, it might have increased a little bit during these, economic uncertainty, but you're still at a really good level of vacancy rate. So it's hard at the moment for people to come into the market thinking, I might not find a tenant. And it might be that the tenancy, the vacancy that they would experience over their term of holding that property just so happens to be happening now. But it's accepting that if you're in this for the long term, you're going to have periods of vacancy. And you need to account for that and allow for that and accept that that's part of what it is. But it's also coming back to, if you bought in the right area, it will never be as dramatic as a problem as you think it will be.
Yeah, 100%. And I would say, though, an extra lever, and this is one of the big things that we talk about with the Holy Trinity, is you want to be buying cash flow positive properties for a start. You want to make sure that they're in areas where you've got strong growth potential. We kind of touched on some of that kind of stuff. And you want to have a value add lever that you can pull. Now, a value add lever might be something like a cosmetic renovation. You might not do that at the start. But let's say you've had tenants for a year and a half, 2 years, and all of a sudden they move out. And they move out at a time where the vacancy rates are a bit higher. Things have changed. This is the whole premise of the Holy Trinity, is to give you a safeguard against this kind of stuff. So what can you do? Well, maybe you can do a cosmetic renovation. You inject a little bit of cash in there, you make it a nicer place to live, you attract better quality tenants who want to stay for longer. And that is one thing that you could do to increase the desirability or the value proposition. You don't have to reduce prices, you can increase the value in other ways. And that's the thing. And that's why we like to have the three components of the Holy Trinity strategy.
Yeah. And it's also if you think about the cash flow positive side, if you do have a couple of weeks where it's vacant, there's not the crazy extra mortgage burden on you if you are negatively geared.
Yeah, well, that's it. I mean, if you're negatively geared, you've got a liability 52 weeks of the year, not 2.
Yeah.
Like that's the thing. You've got a negatively geared property. You could have it tenanted. You could have it tenanted year round, and you're still going to be digging into your pocket, right? Whereas if you've got a cash flow positive property and it becomes vacant for 2 to 4 weeks, well, that's a 2 to 4 week window where you need to manage the finances of that asset. But if you've produced a surplus within that asset, you should be able to do that too.
Awesome.
Great, awesome. I think it's been a great episode. Thanks, Gabby.
Thank you, Goose.
My pleasure. Now, if you have enjoyed this conversation and you want to find out a little bit more about property economics, the way we think about stuff, different other levers that you can pull within your property portfolio, I encourage you to grab a copy of my little book. It's called Limitless, The Renegade's Guide to Building Wealth Through Property. We talk about the multitude of economic drivers in the property market, how you can build a strategy to survive and thrive no matter what happens, even in an environment like this, and all of that kind of stuff. And if you want a copy of that, just head to renegadespropertybook.com. And also, if you buy the book, wonderful, amazing. I can't wait to hear from you. But also, if you actually just want to join a community of like-minded people who are exploring all of these ideas and topics and having integrated conversations monthly, or actually every 3 weeks, we're doing a training and an exploration on different aspects to improve your position and your success as a property investor or a real estate entrepreneur, then head to theinvestorlab.com.au to find out the many ways that we can support you on your journey. Thanks so much.
Thank you.